Maverick Traders. Welcome out to your trading room for September 26th through the 30th as we prep for the week ahead. As always, a quick reminder to make sure you follow your trading plan, and let's get to it. So, last week was very eventful and very bearish. The FOMC meeting came and went, and markets really took off on the downside. The Fed continues to strike this hawkish tone, and they've been pretty consistent in saying that that is their number one concern, which is price stability, inflation. It's good that they finally came around to worrying about that after, calling it transitory at the most critical moment. They certainly screwed that one up, which is sort of mind-boggling when you think about it. When literally, if you were to ask the Fed, what is the major risk of their balance sheet going from 1 trillion to 9 trillion from 2008 to 2021? They would have said, well, the major risk is inflation. And then when inflation was ramping in 2021 and housing prices were booming and crypto was booming and NFTs and all of this massive amount of risk, when literally inflation was skyrocketing, and that was the critical moment, and they came out and just every one of them, there was not one dissenting vote. They all said it's transitory. We're going to keep the pedal to the metal. We're going to keep buying bonds. We're going to keep pumping liquidity. It was just a huge, huge policy mistake. So now we're on the backside of that, which is inflation's gotten out of control. They were so slow to move, way behind, and they have to admit that they made those mistakes. So now they're battling the other side. And here's the thing, the Federal Reserve is a trading group, right? They have to look at economics, make projections, actually are active in the markets, buying and selling securities. They are a trading team. And the thing that I always look for in a trader is the ability to shake off a bad loss or something that you got wrong and not be afraid to essentially take that same trade or do something along those lines that might make you look bad, but you know it's the right trade to take. And so I feel like the Fed, to a certain extent, is now basically locked in. They made the prior mistake, so they have no choice. They're just in this bad trade and they have to try to fix it. When right now the data is actually suggesting that they should adjust, that they should go back to, hey, we don't have to kill the economy. We don't have to see unemployment skyrocket. You're already seeing oil's back below $80 per barrel, and it was the last kind of holdout. You're seeing all these prices decline, and all these data points that they're looking at, like inflation numbers, are all lagging. So yeah, they screwed up before, but that doesn't mean they have to make the other side of the policy mistake, and that seems where they're headed. So yields continue to blow out. The US dollar is at multi-year highs. It just continues to get really ugly. Interest rates, the 2-year trading at 4.2%, higher than the 10-year. I did a class on this a couple of weeks ago and talked about the 10-year 2-year spread, and when that goes inverted, and we looked at the history of it and how it's a leading indicator, and then usually about a year later or so economic recessions come about, and I would fully expect that. I think we're headed towards a recession. We talked about that when we made the video. Inflation is obviously the key component, and it needs to be where we kind of focus on. If you're worried about the Fed and changes and such, well, you've got to pay attention to inflation. This latest inflation number was really, really bad for the markets. And the more inflation stays up, they just know the Fed's going to be battling that and hawkish and reducing balance sheet and so on. In just the same way that QE pushed asset prices higher, the quantitative tightening, QT, is pushing asset prices lower. So it's kind of a don't fight the Fed in the other direction. The Fed ended up hiking by 75 basis points. It was debated whether they would go a full 100 basis points, but they went with a 0.75% rate hike. Flash PMIs here in the US beat expectations. So as you look at things, again, they went from 2.5 to 3.25. They're kind of targeting going into the fours. That's where they say they're headed. So that means more interest rate hikes coming up. And I don't know why they have to be so slow to do it. Why not go a full 1% on this last one? Why not rip the Band-Aid off to a certain extent? But they, this is the way they operate. Whether it's certainly debatable whether the Fed is a good thing for markets overall or whether they create a lot of the problems themselves. So market performance, you can see it was a bloodbath. Dow, S&P, NASDAQ, and especially the Russell 2000, all down about 4% or more. The Russell small caps got hit particularly hard at down 6.5. Oil got hammered. Gold is not an inflation hedge, my friends. Neither is crypto. They have traded horribly this year in the face of higher inflation. And the thing is that risk assets, a lot of times the correlation of them goes to 1, meaning when markets really get hammered, there's very few places to hide. Usually treasuries do well. Usually US dollar does well. You hide out in defensive things. People feel safe in cash and backed by the largest economy and the biggest military, so people hide out in the US dollar. Well, we're seeing that US dollar is skyrocketing, which actually adds again more pressure to risk assets, more downward pressure to international stocks and international markets, and just create some other headwinds for markets. So right now, it is certainly a risk-off environment out there. But as we take a deeper dive into this chart, what do you see? Well, we came all the way down to this critical level is where we were hitting on Friday. We did hammer off of it. You can see the long lower shadow. Oftentimes, very oftentimes, hammers create temporary bottoms at least. I'm not ready to call this the bottom by any means, but a temporary bottom. And what would a temporary bottom look like? Well, what I'm envisioning is some form of an inverse cup and handle that we bounce, but that the bounce kind of creates that handle effect. Are we likely to pierce that low? Yeah, sooner rather than later, we'll probably be below that low. But I would love to see a bounce. If we do some back of the envelope math, you can take the lows to the highs. Remember, this is our inverse cup and handle. So here's your cup, right? And then we would expect a handle out here to maybe form. So you take the lows to the highs, right? You take the distance of that. The lows down here are in the neighborhood of about 363 or so. The high up there was at about it was about 431, 432. We'll call it 431. This doesn't need to be exact. If you take the distance, that's the cup right there. That's the size of it. And the distance from the lows to the peak of that cup is 68 points. How big should the handle be? Usually it's about 30% of the size of the cup. So if the cup is 68, well, the handle's going to be about 30% of that, which would be about $20 and 2040 or something like that, right? Would be about 30%. So in other words, you should bounce off of this low about 30 points, or pardon me, about 20 points. About 20 points would be 30% of the size of the cup. So 20 points off of 363 puts you at 383. So that's kind of the number where this top of the handle should be. And 383 is right there at really kind of the breakdown point. So I think we probably get a little bounce up to 383, and that's where the handle is formed, right? The cup, let's review. The cup went from 363 at the major lows to 431. That's 68 points. 20 or 30% of 68 is 20 points. So the handle should go up to about 383. Again, that's a ballpark number. Anywhere around 383 is your bearish entry point. And from there, we probably go right back down, break those lows and so forth. So I would be, you want to get bearish on this market. There's certainly the opportunity to bounce from that low, and we started to do it on Friday. I don't know if it'll follow through immediately, but that would be the hope. QQQ, very similar. I mean, it's basically the same picture, the same inverse cup. You could get the bounce and the handle here. We could do the math again. It's ballpark. It's about 270 at the bottom, roughly. The high up here is at about not quite 335. We'll call it 333, something like that. And again, this is in the ballpark, right? We're just getting a ballpark figure. The cup is 63 points. What is 30% of 63? It's 1890. So call it 19 bucks. That means from the 270 low, you bounce about 19 points. That puts us at 289. Whoops, 289 here is about where that should stall out. So somewhere in that area, roughly 289-ish on QQQ is probably where the bounce will start to stall out. So volatility index here, you can see it really started to blow out towards the end of the week. Friday was an expanded range bullish candle. Yes, we started to fall off the highs. Major and even minor bottoms usually have, when there's momentum in the VIX like this, usually have a little bit of a long upper shadow. And when you start to see the long upper shadows, then you have a little bit of a pullback, a decline in the VIX, which entails the market's probably rallying temporarily. So see these high waves and then you get some pullback in the VIX. Well, that's what we're talking about. The VIX just pulling back for a few days, as would happen if the stock market is bouncing for a few days. And this is a level where that could easily occur. As we look at this week's events, again, I kind of see it as maybe it's wishful thinking, maybe it's hopeful thinking, but we've broken the uptrend line. We talked about that over the past couple of weeks in the market roundup. I don't know if I told you, it's Corey here with you today. I do the market roundups on Tuesdays. And the last few weeks, we've talked about that uptrend line that's been broken, and that means trouble. And we go back to the lows. Again, maybe it's wishful thinking, but I think an inverse cup and handle can easily occur here. It looks like the setup, and that should be a really good bearish entry point, which, by the way, is the better trade than even trying to buy the bounce. Do we bounce early next week? Probably, but far from a sure thing. Fed Chair Powell on Tuesday and Wednesday comes out and talks. On Tuesday, he'll be talking about digital currencies. He's in a conference in France, and then I think on Wednesday he does a speech and maybe an opening for a Fed meeting in St. Louis, if I remember correctly. So he'll be in the news as per usual. Will he give any attempt to calm the markets? Does the Fed care? Are they, happy that the stock market's declining, that prices are coming down, that the economy is likely to get weaker? Maybe that's some of the things that they're hoping for. Final GDP comes out on Thursday. You'll notice negative numbers, and the White House has made it a point to suggest that, that does not entail a recession. Well, even if we're not in a recession right now, it's very, very likely. But the recession does not have to be severe. In fact, most economic recessions are not catastrophic. They're not 2008 global financial crisis, Armageddon type of scenarios. Instead, they're a slowdown, and the economy slows and unemployment ticks up and all those things, but they're not a catastrophe. In most recessions, the stock market doesn't go down 50 and 60%. It goes down 20, 30, 35%. And guess what? That's about where the stock market has gone, is down over 20%. So can it go another 10, 15%? Of course, certainly possible. But I just remind you that a lot of times we think about the worst case scenario and we think that that's what's most likely, and it's certainly not. A massive, deep recession where the stock market absolutely gets clobbered is not my base case. I think we're in or headed towards a recession, but I don't expect it to be massive and deeply severe. In fact, I would expect the Fed will probably have to come and you know, fix some of their policy errors now that they're making them on the other side of things. So, weekly outlook. Obviously, we're bearish. I mean, the slope and all these things are turning down big picture, right? But where are you at in context? And we're overdone on the downside. We've been falling for the better part of maybe 10, 15 days in a row, basically. And you have a hammer. If not now, then when? I mean, this is where we should bounce. So for the week, I'd expect a bounce. Do I want to trade that aggressively and so forth? No. Could I trade it a little? Sure. There's no question you could try to look for a short-term bounce if you're a short-term trader. I still think the better risk to reward is hopefully we get that bounce and then we create that inverse cup and handle, and you're going to have a nice additional bearish entry point, and hopefully you've been trading bearishly since the trend line broke. Again, once that trend line broke, that was a big turning point for markets. Now, as we look at the sector, energy certainly got hit the hardest, down 10%. Consumer down 7, real estate down 7, but there was nowhere to hide. They're all bearish, and our outlook continues to be negative for each and every sector because nothing's really holding up. And energy was one of the better holdouts, but it succumbed to the pressure this week, and oil really got hammered. So utilities, they had some promise here, but that was broken, right? And once that broke, prior lows and so forth, it started to sell off like everything else. Now, utilities did fill this gap, so it's an area where it should bounce. But just like the markets and such, it'll probably be short-lived. It's not as bearish as some of the other sectors, but still at least a -1 in our view. As you look at the XLC, so communication type stocks, as we look at this, okay, there was the support for XLC. Once that level broke, it was, away we go to the downside. And what's particularly bad about this is obviously the stock market's at its prior lows and the communication services sector is below those lows. I mean, we're already making new 52-week lows, new multi-year lows, and so forth. So relative strength or relative weakness, well, relative weakness in this case. So -3 on that. You'll probably get a bounce. I mean, these are all heavily correlated right now. They're all kind of moving together, but that one's particularly bad. Real estate, again, has broken that level of support. So, you can kind of do a quick comparison of what's better than, what's worse than, based on which ones have taken out those June lows. Real estate has done so, and as such, obviously very negative, very bearish from that standpoint. Industrials at the lows. This would be kind of a market average. This is very similar to the S&P. You should get a similar type of price pattern where we can bounce, but that probably is a bearish inverse cup and handle type of pattern. -2 as we see it. Continuing. So here's healthcare, and healthcare has held up in terms of comparisons and whatnot. It's held up better than the markets, right? We're above the June lows and really, decently above the June lows. So what did we look at previously? Communication services, real estate, which was below the lows. There were some other sectors, industrials were kind of market average. Well, XLV is above those lows, so a little better than the S&P, a little better than the NASDAQ from that type of comparison. Now, is it great? No, but it's a little bit better than. -2, still bearish. Remember, we gave the markets a -3. We gave the S&P its big picture outlook a -3, so a little bit better than that. Financials, again, still above those lows, or at the lows is probably better stated. So it's kind of like industrials, kind of in that market average. And, frankly, it's probably in that -2 category. It's not worse than, but it's kind of at least equal to. Consumer. So consumer, I mean, most of these sectors, like the market, had uptrend lines that were broken recently. The consumer was holding out pretty well and doing much better, well above those lows. So you'd still have to give it more of the benefit of the doubt. Again, just technically speaking, -1, not as bearish as so many other things. Tech, back at the lows. This very similar to obviously the QQQ, the NASDAQ 100, and very similar to the S&P. So in that -2 to -3 category, we gave it a -3. It's pierced the prior lows. So relatively weak or equal to the markets. Material stocks has broken the lows. This is really commodities X energy. So this is more of the materials like gold mining companies, copper, steel, aluminum. Not great. The underlying commodities are bearish, have been trading at new lows, and well, the stocks have as well. So -3 on that. XLE. So here we're looking at energy stocks, and the energy sector had its uptrend line like the S&P that was broken, which spelled trouble. Really it had a symmetrical triangle, kind of like the S&P. It broke to the downside, and then on Friday, boy, did it get hammered. But we're still well above the June lows. Again, relatively speaking, holding up well, but not great price action, -1 at least on that. So as we look at the sectors, a lot of damage done. Some of them back at the lows, some of them below the lows, but as you stack them up, they're all on the bearish side. The only thing that was really year to date that was still up was energy. And energy was kind of that, again, that final holdout, but it had a very bad week. People were kind of trying to hide out in it. And you can see the panic that spread through the markets today, specifically, as energy just got blasted. Today was kind of a bit of a capitulation where people threw in the towel and said, I can't even hide out in energy. I got to just sell and get smaller. So it was kind of a lone holdout there that really succumbed to the pressure. Possible trade ideas. Let's look in the utility sector. So CEG in utilities is back to the prior breakout point. So a level of support there that you can see. As we look at possible trades, you could just do a typical bull call spread. I wouldn't get too aggressive, but targeting a move back up to the prior high. I mean, what a better looking chart than so many other things out there. Now, again, it might struggle big picture with everything else going down. A lot of these last holdouts will come down as well if the market continues to break down. But CEG holding up relatively well. Communication services. So here we've got spot back at the lows. Okay, you can see kind of this big process that it's come back to those lows. How would we trade it? Well, you can probably go with a few different types. You could do some sort of diagonal put spread. You could play it as a bear call spread. I think it probably even makes sense that if we start to bounce early next week, that you even wait for that bounce for a couple of days and then short on the rally. But anyway you slice it, probably some sort of bearish spread is in place. Something like a bear call, bear put type of spread would make sense on that one. Healthcare. So healthcare, again, like we talked about, it was holding up relatively well. AMLX back at the prior levels. So that's a line of support there. As we think about possible trades, kind of conservative here, doing some sort of diagonal call spread, just expecting the stock to be, maybe a little bounce up towards 30. Rob likes to test it, see if it's getting some bounce. If it is, then that September 30th can expire, or we buy it back. And now we've got a call, an underlying call that is making money. If it's not working, well, we can get out with, pretty quick at the September 30th expiration, get out of the trade if it's not working, stick with it if it is. But AMLX, again, holding up better than most. Industrials. So here we've got SBLK back at the lows. You can see kind of this, descending triangle, bear flag, whatever you want to call it, type of pattern. Down at those lows, probably going to continue to trend down and through those lows. So you could just go kind of conservative, a bear call spread. Expectations would be that it will not finish above 20 and that it will finish below 1750. So 1750 or lower would be the target. Max losses if it finishes at October above 20. And again, that's possible idea there. Financials. So KKR broke down, back down to these levels of support and below. So anything that has kind of pierced that low or is at that low has the potential that this is a little bit of the area where we could bounce. But would I still be bearish on it through the bounce and looking at these bounces to get short? Absolutely. Again, inverse cup and handles, etc. So KKR, diagonal put spread, and notice the conservativeness of this, selling a 42.50, which basically the low we hit today was 42.90. So you're not really targeting much downside in the immediate term, but you can kind of test it, and ideally it just kind of, is in this range. And if you've got some profit, you could keep holding that October and see some profitability. If it's not profitable by September 30th, then you can bail out. So it's a good little tester trade where you do a diagonal, and if it's not working, go ahead and get out of the trade. Consumer. So Poshmark holding up relatively well and really having a good couple of weeks. If you look at a long-term chart of this thing, it's a disaster. You look at the short term, and it's actually trading pretty well. Kind of a bull flag, high base type of pattern. I don't know why it's doing so well in comparison to other things, but again, some sort of diagonal, something like that, where you're kind of targeting this stock to hang around 15 or higher. Anything that is doing this well in a bad market probably has a little bit more to go. I mean, it's been able to withstand market pressure. It may continue to do relatively well. So relative strength, relative weakness matters. These trends, momentum, they tend to play out. And a lot of times they shock and surprise you at how long they can go. In technology, HCP, back at the lows, little inverse cup and handle type of dynamic in place. So we're thinking diagonal put spread or bear call spread, something along those lines. Again, our target, not real bearish, 27.50, which was kind of at the lows of today. And just a little tester trade. Probably the market's due for a little bit of a bounce or consolidation. And then you can make hay on that October put with the breakdown that follows. So HCP, pretty ugly bearish chart overall. Materials, no surprise again, more bearish. Here's Mosaic in the fertilizer space, broke the level of support. Now, I would say that Mosaic has held up relatively well and that it's above the June lows, but has just started to break trend and break below those key levels, so has room to continue lower. Something like a 45.50 bear call spread. Expectation being that the stock will be at 45 or lower at October expiration. So Mosaic, Again, very bearish price action today. FRO in energy. Here you can see it's kind of come back again to maybe even this uptrend line, this kind of area in here, the prior little breakout point and such. Just becomes a little area of make or break type of dynamic for FRO. I didn't love that it gapped down today, but it did bounce off the lows. And this is one where if it can't hold right here, you could just pass on the trade. If it starts to pivot higher, it should go up and fill this gap. So a $13 price target. And I wouldn't be surprised. Again, today felt kind of like a capitulation, kind of a throw in the towel type of day, especially in energy, like I talked about, where people were hiding out. Today they panicked and just sprinted for the exits. That's usually much more of a short-term bottoming dynamic. Once everyone that's willing to sell has sold type of thing, now the bottom's in. Nobody's left and willing to sell at these prices. Well, I don't know if today was the low. It's possible that, there's one more day or something of selling, but it's pretty close there. So FRO is a possible upside bounce candidate. In conclusion, we're at the June support and at those lows. A possible bounce here, inverse cup and handle is likely. Watch your trading, certainly more of a bearish mix overall, like we've been talking about the past couple of weeks, makes sense. I do the market roundups on Tuesday, and I've tried to emphasize that point that we're still in a bear market, and that bears repeating, right? When you're in a bear market, it's much easier to focus when you have bearish trading opportunities, because if the big long-term trends are going to go down, sure, there's a few weeks here and a few weeks there where you can play for a bounce, but the easy trade is with the dominant trend, and that has been and continues to be in 2022 on the bearish side. For the rest of this week, we've got some toss charting techniques on Tuesday. We'll have our midweek update on Wednesday. And then, of course, we'll do our weekend trading room recap. Have a great rest of your weekend, everyone. Be safe out there, and we will see you next week. Goodbye.